Welcome to Restaurant Deal Making Exposed, the only show that equips you with everything you need to know about restaurant transactions. In this show, we tell you all about how to make the sale or purchase of your restaurant not just possible, but successful. Now here are your hosts, ex-restaurateurs and seasoned brokers, Patrick Toda and Andy Mirabel.
Hey everybody, we're here again with Restaurant Deal Making Exposed. Today, we are going to talk about market-based valuations. So you got a valuation from your CPA or a third party. Is that really what your business would sell for? Today, we're going to unpack the difference between accounting-based valuations versus deal-driven market-based valuations from a specialized business broker. Every now and then, I go to a listing appointment and I have a seller who provides me with a valuation from their accountant. I respect my clients who do their homework, yet when they share their valuation with me, I often find the valuation is not realistic and based on true market value. When our restaurant brokers and restaurant realty provide you with our broker opinion of value, we provide relevant recent comps to support how we arrived on our suggested price. We obviously want to get you the highest price for your business. However, we have to be realistic and justified in our approach. So, Andy.
This is an interesting topic because we have some valuation methods because we are specialized, because we have so much empirical data specifically on restaurant transactions, bar transactions, food-related transactions. That just shows, again, that we're hyper-focused on this industry and that's all that we do. Obviously, that when we have conversations with leads or potential clients, sometimes they bring in their trusted associates, which we totally respect. That could be a CPA, that could be an accountant, that could be their family member who knows their numbers. I don't know. But a lot of times we have to respectfully push back on the valuations or opinion of values that come from those parties, because although we don't want to disrespect or discount what is being put in front of us, we have to, with real market data, show them what the business is worth. So why don't you talk about a couple of our valuation methods that we use, the two most major ones?
Yeah, I mean, the two most major are asset sale valuation and a going concern. And so what are the difference between the two? An asset sale is going to be either a business that you're selling that for whatever reason, the name, menu, goodwill is not included. Basically, it's a second generation restaurant. You're buying a place for you to put your own concept. And maybe that restaurant was closed down already. Maybe it's still running. And so with that method, we're basing our value on the revenue of the space, and we do a percentage of the revenue.
To clarify on that one too, just to chime in a little bit too, just so our listeners can understand, yes, it could be a closed restaurant. It could be a restaurant that's underperforming, has low volume, losing money, limitedly profitable. It also can be a restaurant with very high volume. We sell asset sales of restaurants that are selling $1.5 million, but they're losing money. So those do fall into that category.
Absolutely. And I would argue that even with an asset sale, let's say you're buying a restaurant, you're going to put your own concept in there, or you're going to take over and change the name, and it's doing $2 million in revenue. That revenue is not going to just disappear. So there is some goodwill that potentially can come in there. And I think it's about whether or not you can capture some of that revenue. And so that does get factored into the whole thing.
Yeah, I'll call that residual goodwill.
Yeah, I like that. That's a good term. So the other method is the going concern method. And the going concern is going to be a restaurant that you are buying the goodwill, the name, the menu. You're going to continue to operate it as it is right now. And that method, we're going to take your profit and we're going to do a multiplier on your profit. And so when we do profit, we do an adjusted net income. And so we're going to add your net profit plus owner pay and any other add backs that we can justify in bringing down to the bottom line. And we're going to use that number to do a multiplier on.
Yeah. A lot of general commercial brokers still use the EBITDA, earnings before interest, tax, and amortization as the way to figure out true profit. We often call it seller discretionary earnings because we're adding back personal expenses that these owners run through the business. Now, we're not talking about every darn thing. I have a client that I met with yesterday and they brought me their credit card statement, be like, this is all the groceries and everything I bought through the restaurant. I said, that may be true, but an SBA lender is not going to look at 85, 90% of these add backs that you're suggesting we add back. Yeah. So we have to be smart about that too, on what we include and what we don't to come up with the true profit.
Yeah. And I mean, I think you have to kind of consider when you plan on selling your business, and start to plan that out 2-3 years ahead of time and try and make your books as clean as possible. Because if you are going concerned method of valuation, hopefully you can qualify for an SBA loan, and that's just going to be the perception of you selling that business is going to be a much higher than a tax return with all these adjustments that you have to add back out. And so you just want to think about that and plan when you want to sell your business.
Yeah. So why do our clients sometimes go and ask about their opinion of value from their CPAs or a third-party evaluator? Why do they start there first? Well, a lot of times I would guess that, one, it's a trusted associate of theirs. They've worked with them for a long time. Two, you kind of think as a business owner, let's go to the number people. They know my numbers. They know what assets I have on the books. That should be the direct path to figuring out the value of my business.
Yep.
And one of the things I did before we did this episode is I reached out to one of our past guests, the lovely Don Angle of Angle Accounting. I've worked with him and known him for nearly 20 years now. And I said, Don, help me put this into terms that we could share on our show. Why do people take either our opinion of value and go back to their CPA, or why do they start with their CPA for value before they come to us? And he literally chuckled. He said, I'm having a conversation with one of my clients about this today.
Yeah.
And Don is a very pragmatic, sensible person. So he really does side with us, you and I, Patrick, about how practical our valuations are and how realistic they are. He said, CPAs and accountants can often offer balance sheet valuations. They do this by adding up assets on the books plus liabilities plus equity, which should equal, in their theory, the value of the business. The equity is the amount investors put in. I don't care if an investor put in $1 million. If you're losing money, there's no value in that. So we can't get that. We can't recoup that money. Okay, so he really added some fuel to our fire on this topic that Restaurant Realty, Patrick, myself, we use market-based valuations. So it is what the market will bear, what the buyer will pay for the assets. That is the value of your business. How do we place value on the tangible and intangible assets?
Yeah, that's a really good question, because they're doing it based on hard value of whatever the depreciated value of the equipment is, what the total inventory is. Like you said, the investment into the restaurant. We're placing it based on either revenue or the adjusted net income. And so if you want a $1 million valuation on your restaurant, then you have to be doing profits in at least the 300 range, right? Like Are we taking into consideration what equipment is in there? Yes. Do we take into consideration what assets the business owns, like a Type 47 liquor license? And depending on what county you're in, that could change the overall valuation. Absolutely. But, we're really placing an emphasis on the actual revenue and the actual net income.
Yeah. And let's talk about California in general, in the Bay Area where we are. Inventory is very high. It has essentially stayed a buyer's market since 2020. And so there's so many second generation restaurants out there that have been built 2 years ago, 5 years ago, that are beautiful inside. And I can find really stunning restaurants, and we can be selling them often for $150,000 or a ballpark. Obviously, it might have cost $1 million to build it out, but that's what the market will bear. You brought up assets. Now, a general restaurant you would hope has a good kitchen setup, a hood, some real basic core elements, walk-ins, things like that. Now, if it has a $100,000 rotating Forney pizza oven, I've brought this up as an example before, sure, I'm going to add some value to that and really emphasize that. But in essence, this all goes just back to what the market will bear and what a buyer will pay.
Yeah, I think we've gotten a lot of in the last few years with people who have spent an investment on their restaurant, build out and what they perceive their restaurant to be worth, but the restaurant's doing $50,000 a month in revenue or something, right?
Yeah.
And it's like, unfortunately, you're right. Your restaurant is worth more than what we can potentially sell it. I think that's the disconnect, unfortunately. Like, obviously, if we could sell it for higher, we would want to.
Yeah.
But if your revenue is not supporting the number, and I think that's the big difference between this book value versus our
market value. Yeah.
Market value. Yeah.
True. We kind of touched on add backs before. Is there any other things we need to maybe touch on that topic about personal expenses or one-time costs that we add back? What are the major ones? What are the major ones we're always looking for?
Yeah, so we're going to do one working owner and the wage and the payroll tax for that. We're going to do amortization, depreciation, interest, and net income, right? That's the beginning part of it. Then from there, I'll add back in like healthcare for the owner. I'll add back in auto if the car is not being used
If it's not a truck for the pizza
Yep.
business, yeah. If
Yeah,
it's their
yeah,
personal
yeah.
truck, their auto
Yeah.
insurance, their car payment, their tolls and parking for their personal car, we can add that
Yeah.
back.
Research and development, that's you go out and find new menu items, I think
Yeah.
is what
Yeah.
they
Travel's another one, right?
Yeah, those are the basic
Donations.
ones
Yeah.
right there. And then from there, it gets a little bit more tricky, right? Like you have your cell phone that you're writing out and your quote unquote office expenses. And then there it gets pretty creative from there on what other people
Yeah.
like to add back. And so you have to kind of really like dig in deep sometimes. And if you can justify these costs then and build a story around them, I think it's fair to do so, but it starts to get tricky as you get further down that road. Yeah.
Let me use two real life examples I have going on right now with two of my clients. I have a client in the quote unquote East Bay Delta area in a very fast growing neighborhood, and the neighborhood's just kind of grown in around him. He's a one man show. He has one other employee with him. And I kind of unfortunately had a preconceived notion about the notes I received about this lead before I called on what I was getting. And the sales are very low. The numbers, if I just looked at the numbers, I thought it'd be a very low priced asset sale. And then I visited his restaurant. And it is one of the more stunning restaurants I have seen in the last 24 months. It is absolutely, It could be transplanted to Vegas, New York, San Francisco, white tablecloth, grand piano. You know what I mean? I was put back on my heels a little bit. So did I, after that, seeing all the equipment in person, seeing how it's maintained, did I adjust my price? Absolutely. The numbers didn't justify my price increase. The equipment leasehold improvements did this in this case, which is not common in what we do.
Sure.
The other example I have is going on currently right now too is I have a kind of an old school Italian fine dining restaurant in a very nice neighborhood. And I based it totally did the valuation based on their bottom line profits and got it SBA pre-approved. But what did I add extra value for after the fact? Their lease was so far below market and still has 9 years left on it. And it is in a very affluent neighborhood. So these are some of the things that we have to make a judgment call after the fact where we're not just looking at numbers. And those are two just examples I thought I would share.
Absolutely. And I think it speaks to the fact that this entire approach is holistic. It's not just like a cookie cutter type situation. Like you have to look at all things, put that all together. And then from there, your multiplier or the percentage of your revenue that you're using for your valuation is going to go up or down based on the total package.
Yeah. Well, we touched a little bit on transferable goodwill. If this is a profitable business, and actually in all of our transactions, when we have allocation of price, we take goodwill as one of the categories to allocate purchase price to. And obviously for a business that's profitable or popular, goodwill is there. You can see it. And a buyer who's taken over the name, the branding, the concept, intellectual property rights, that has a lot of value because you have a client base already coming in, a customer base already coming in your doors and spending money, and that won't stop unless you totally screw things up or change things. But we touched on it earlier is there transferable goodwill for asset sales? And I think that comes into play when you're getting a busy location. You have a neighborhood around you and a lot of those regulars, whether the business is performing or not. I think it's something to take into consideration. I don't necessarily add a lot of value to it on an asset sale, but it's there.
Yeah, I mean, so I get this conversation with buyers all the time. They're like, well, I'm buying a restaurant that I'm going to put my own concept. Why should I give them? There's no goodwill. I'm like, no, I understand that you feel that way, but there really is goodwill. And I speak from experience of my own. And I've said this before, I'm sure. But when I bought my restaurant down at 4 Embarcadero, I had to change the name immediately upon purchasing it. And within 2 years, I doubled the revenue that I previously had. So in fact, changing the name created like a buzz, and I had the baseline revenue already walking through that door, and then from there it just grew. So I mean, changing the name doesn't have to be a bad thing. It has a negative perception, and I think people just want to like consider it like bad right off the bat, but you have to really think about things like people don't just change their patterns overnight.
Yeah, I think what we're trying to say is that we don't stamp the value on each business solely based on financials. It has to be on real life data and the things that we see within the business, their trends, and the community it sits in, and of course, the market and economy as a whole.
And that could be different on a city by city basis. I mean, you could have the exact same set of criteria in one city, and then if you have it in like another city, that percentage that we use or that multiplier that we use could be slightly different just based on that location.
True. So we really touched on a lot of the things that we look for in coming up with an opinion of value. Again, we want to be market-based and basically grounded in reality. What if a seller is willing to offer seller financing on a business that's not necessarily SBA approvable? Do you think that adds value, or do you think that is just helping us with our marketing of the business?
I think it adds some value. Also, I think from a perception standpoint, I think the seller is giving the buyer some sort of
it's opportunistic, right? It's giving an opportunity to more buyers.
Yeah, I mean, when you're using other people's money, that's always a good opportunity. But, the seller's showing confidence that, hey, you're going to be able to make it in the space and I'm going to lend you the money because I know I'm going to get my money back, right? So that always is going to help make a buyer feel a little better.
Yeah, got it.
And also ongoing, I think a lot of buyers are always a little scared that after they take over a space that the seller is just going to disappear. And maybe in some cases that's what they want. And in other cases, they want to be able to have that seller as a resource. And sometimes having that person for the next 6 months or a year just to be able to call for 2 minutes, or it's helpful for a buyer. So
yeah, I'd encourage to our listeners, if we're not going to divulge our industry secrets here on what percentages we're using for what level of restaurants, but you have an avenue to email us, reach out to us if you are interested in selling your business and learn more about our valuation methods. And we're happy to discuss, really share how we really break this down and get to the bones of a listing price or a suggested listing price. When is it actually useful for clients to reach out to their accountant, CPA, and those sort of trusted advisors? When do you think that's useful? I know earlier you said you love when they're doing their homework, and I do too. We want them to look through multiple lenses and not just wholly rely on us until we prove why we've come to a suggested list price. I think obviously the books-based valuation or balance sheet valuations can be really good for ownership changes or partnership changes, right? If one partner is buying out another, that might be useful in that situation.
Absolutely. Or a divorce, it would be perfectly useful for something like that to kind of separate everything.
I don't know what you're talking about with that. We didn't use that in our divorce. No. Yeah. Estate planning.
I was going to leave that out of it, Andy.
It's okay. I'm an open book. Estate planning, things like that. There are reasons to use the books and the book value, the balance sheet value there's a lot of reasons to use it. But I think our job is based so heavily in the market value and what buyers will bear and what buyers will pay.
Yeah.
That's really what we're trying to impress on everybody today. So what do you think? Does that kind of sum up the differences between the two, Patrick, and why we do what we do?
I think it does. And I want to just put this out there. Obviously, again, we want to sell your business for as high as possible.
True.
And as long as we can justify going to market with a price, we are happy to do so. But one of the number one reason a business doesn't sell is usually an inflated price.
True.
And either it's not going to sell or it's going to take a really long time to sell. And by that time, you're going to do a couple price reductions. And so with a business, you really want to price it right from the get-go. You don't want to let's tack on an extra 300,000, see what happens. See what happens things does not work with a business sale.
Yeah. And unfortunately, we see that all too often, right?
Yeah.
With maybe unspecialized commercial brokers listing a restaurant or a bar. I do want to say that flexibility is paramount in the relationships that we have with our clients. So
absolutely.
Sometimes my clients want me to go in blind, create an opinion of value based on what they've shared. I put my number forth and I say, Mr. and Mrs. Client, are we in the same ballpark on what I've suggested? You know what I mean? And if we're not, then maybe we got to walk separate ways. Sometimes we do have to find a little middle ground, and I will have flexibility because if my client understands that if after 30, 45, 60 days, I'm getting feedback that this is just overpriced or I'm not getting the attention on it that we need, then of course we need to make adjustments down the road with our listing price and listing terms, right?
Absolutely.
So,
yeah.
All right. Well, let's see. Bonus questions. We always talk about good dining, but you happened to be at a concert last night, and I had to respectfully decline your invitation, which really killed me. And your voice is extra sultry today. So what you can tell us about your concert or one favorite concert you've been to in the past, Patrick?
Yeah, let's see here. I went to the Kendrick Lamar show last night, and
you're so cool.
It was a pretty good concert, I have to say. So, yeah. What about you?
Good.
What has been you asked me last time about Spain, so I think it's only fair that we turn what was your most recent awesome dining experience?
Oh gosh, dining experience. I thought we were talking about concerts here. Gosh,
Oh, I'm so sorry. We're changing questions. Like,
hey, we have to be flexible. Yeah.
Okay.
Yeah, no, I don't know, man. I'm so bad at favorites. I could list seeing Roger Waters in New Zealand, like front row doing the Animals tour. That was rad.
What?
Could talk
You
about
saw Roger Waters in New Zealand?
Yeah, I was working there. I was opening restaurants in New Zealand, and there we go.
That's pretty dope.
That was fun. Yeah, there's a million. I'll leave it at that so we don't go too far into this, but thanks for asking. I'll think of dining stuff next time.
Yeah, I want to hear the more details on that show.
Yes, off air. Okay. Well, thank you all so much for listening. I hope this was a nice little snippet on how we really come to market-based valuations, and please tune in next time for our next topic. We'll see you next time.
If you enjoyed today's show and don't want to worry about missing an episode, you can follow the show wherever you listen to your podcasts. And if you found today's episode interesting or useful, please share it with someone you think would benefit and consider leaving a rating and review.
Reviews help restaurant owners or buyers just like you discover this podcast and benefit from the important topics covered in the episodes. Your opinion matters to us as a listener, so feel free to leave topic suggestions and feedback for us, as we will use these to tailor the episodes to you and help you get the most out of listening.
Thank you all for listening to this week's episode of Restaurant Deal Making Exposed. If you're considering selling your business and would like a free consultation, reach out to Patrick and Andy at therestaurantsalesbroker.com or visit www.therestaurantsalesbroker.com to learn more.